I save in gold. I maintain liquidity in U.S. dollars. We could talk later about what would cause me to sell my gold, but this price isn't one of them. As you suggest, I'm a contrarian. And you and I talked a couple of years ago about silver being a hate trade, and I bought it. I bought it because I thought when the hate subsided that the silver price would increase. Guess what? That happened. In my own portfolio, silver represented in my portfolio a speculative asset class, not an investment class, a speculation class. And the reason that I owned it is because it was hated. And when that reason went away, the silver price went up. So last week, I sold 80% of my physical silver. This is a personalized decision. It might not apply to the rest of your listeners. But I note that the internet response to my announcement that I sold 80% of my silver was filled with hate. So I know I did the right thing.
According to Rick Rule, he sold 80% of his physical silver last week after it hit $94 because the hate trade thesis played out. He rotated half the proceeds into silver miners, which are pricing in $45 silver, while the metal trades at $75 to $80. He believes silver equities offer better upside than physical, with his 50 years of experience analyzing them. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
What would cause me to sell my gold? If the reasons to own it went away, which is to say, if, first of all, the U.S. government balanced their budget. Every year, our debt, which is now almost $39 trillion, goes up on balance sheet by $2 trillion a year. So I would need to see a balanced budget. And I would like to see the path clear to a reduction in debt. In 1980, U.S. government debt stood at about 25% of GDP. Now it stands at 120% of GDP. And I would like to see those two numbers normalized. Much more important to me, though, is off-balance sheet liabilities. The net present value of unfunded promises, Medicare, Medicaid, Social Security, military pensions, all that stuff, is $120 trillion. Trillion. And that number grows by about $2.5 trillion a year. So in order for me to sell my gold, I would like to see a political accommodation that explains arithmetically how we fund $120 trillion in off-balance sheet obligations. We either need the pensioners, the guys like me, to say, yeah, well, I understand I paid in for 60 years, but I understand you guys can't pay me, so that's okay. No hard feelings. Or we need some other form of accommodation. By the way, that accommodation is going to be hard to get. If you add the on-balance sheet and off-balance sheet liabilities of the U.S. government, the number comes to $159 trillion. The IRS, whose business it is to know, suggests that the aggregate private net worth of American citizens is $167 trillion. So there's an $8 trillion plurality over what we have versus what we owe. And that number gets worse by $4.5 trillion a year. So I would need to see that problem resolved. But the most important problem, in order for me to sell my gold and go into savings instruments, would be that I need a positive real yield. If the underlying inflation rate is 8%, as an example, traditionally through history, savers have demanded 150 basis point, 1.5% real yield over inflation. That means that the U.S. 10-year Treasury would have to be yielding, what, 9.5? Imagine how the U.S. government, who is having trouble servicing their debt at 3, would do at 9.5. 9.5 presupposes a first mortgage rate, 30-year fixed mortgage rate, of 10.5 or 11, as opposed to 6.7. What would an 11% 30-year fix do to U.S. housing prices? Wouldn't be pretty. Most people, particularly undisciplined people, and this will this will generate a lot of hate all by itself, can't invest in a narrative until the price momentum of the underlying commodity has justified the narrative. Everything that is true about the silver narrative today at $80 was true at $20. The difference is that if the silver price goes from $20 to $80, the value of the narrative is arithmetically only a quarter as great. The coiled spring aspect of silver is used up. People need to understand that. If your reason to own it was mine, which is to say the alleviation of hate, that's occurred. Am I saying that the silver price can't go to $200? No, I'm not saying that at all. I don't care. I bought it for a specific reason. The specific reason came true. I expect over 10 years the price of precious metals, including silver, to be not merely higher, but a lot higher. I have found what is for me a more attractive way to express my preference for the silver trade. I will tell you this. I know how good my timing is and how good my underlying thesis is by how much hate it attracts on X. 10 years ago, I remember proposing renewed investments in the uranium sector, and people were apoplectic in their hate. This is a failed bull market. The stuff has gone nowhere. It's the stuff of Hiroshima, Nagasaki, 3 Mile Island. Fast forward 5 years, and I disclosed that I sold some of my uranium stocks. What a half-wit, they said. A guy steps out of a bull market. Can you imagine anything in the world more stupid? Then the uranium stocks decline, and they say, well, the guy was front-running, right? I know that if I get 30 responses in social media and 25 are violently opposed, that I'm doing precisely the right thing. I own Pan American because I think there's earnings leverage, but I think there's a different kind of leverage that the market has completely ignored. And that is the leverage exhibited by 2 undeveloped silver deposits, one in Guatemala, one in Argentina. These are each 500 million ounce high-grade deposits that aren't figured into the net present value because they don't have any. They don't have any because of political constraints to development. The governments have paid some attention to domestic politics, ignoring the fiscal benefits that will come to the state. The state generally tries to steal somewhere between 35 and 50% of the economic value of a deposit after the payback of capital. That was a fairly small number in these 2 deposits at $20 silver. The benefits to Guatemala and Argentina from stealing, let's call it 35% of the economic benefit after a recoupment of capital are billions. And I don't believe that either government can afford to leave these 2 deposits unbuilt. And you get that in Pan American for free. Free is a very good price. And I'm particularly attracted to redundant assets on the balance sheet that don't contribute to current cash flow estimates, but still have residual value. The option value of these 2 deposits in Pan American, while by no means a certainty, ignores the fact that governments who could ignore the revenue because it was small relative to the domestic political price that they'd pay for development, that avoided revenue in both Guatemala and Argentina is just too high. I believe that there's a probability that a political accord will be found, and that those assets will go back onto active status. I'm a little concerned about the J. I'm interested in the silver miners, not the silver morons. There are a whole bunch of companies that have silver in the name on the share certificate, but they don't have any silver. And realistically, if the price of something that you don't have goes up, it shouldn't impact your underlying value. But when I look at the silver producers, when I look at, say, Pan American Silver, which paid a very, very, very full price for MAG, a full price at $30 silver, and I think about the fact that the Bay Street research reports and the Wall Street research reports, when they look at earnings, are assuming a $45 silver price. If you make the stuff for 75 and deliver it into a forecast of 45, it's impossible that you don't have an earnings surprise. The second thing is that when old securities analysts like me do net present value calculations, we still do those things. If the silver price increases from, say, let's call it any number you want, 40 to 80, so the silver price doubles. If you were a producer making silver for 20 and selling it for 40, you have a $20 margin, and the silver price doubles, your margins quadruple, triple or quadruple. It's important to understand that. And the valuations of the silver stocks are discounting lower silver prices. If today's silver price holds, and I think they can, the net present values that we've ascribed to those producers are unrealistically low, and we have earnings surprises. It's as simple as that. I feel good about the silver price over 10 years. I think that 2026 is probably a good year, but I don't think it's a year that repeats the performance that we got in 2025. So I don't want a big bet on my part in a near-term increase in the silver price. What I want is a bet on the increase in margins and the increase in net present value on the more efficient producers, or on the very, very, very high quality developers where mine construction looked fairly certain at $35 and you go into an $80 world. If you have people trading off net present values established in preliminary economic assessments at $30 silver, and you rerun that same net present value calculation at $50, $60, $70, or $80 numbers, the difference is stark and it's dramatic. Let's introduce a little history just for fun. As you can tell by looking at my image, I've lived it. In the decade of the 70s, the US dollar lost 75% of its purchasing power. Not coincidentally, in the decade of the 70s, the gold price rose from $35 to $850. There is some correlation between the deterioration of the purchasing power of the US dollar and, importantly, real interest rates in fiat currencies and the reaction to the gold price. That's the good news, because I suspect that in the next 10 years, we'll see another 75% deterioration in the purchasing power of the US dollar. I say good news advisedly. And that should fuel continued increases in the gold prices. But a couple things you need to know. While I believe that in very rough terms, the nominal price of gold, the US dollar gold quote, increases in inverse measure to the deterioration of the purchasing power of the US dollar, what I guarantee is volatility. We will experience in the next 10 years at least one, probably two, 30 or 35% declines in the gold price. We experienced 3 of them in the decade of the 1970s. But the other thing that people need to look at is the chance of a real decline. I remember well, in the period 1970 to 1975, the gold price increased from $35 to $200 an ounce, a 6-fold increase. And because of that increase, a whole bunch of people who didn't want to own it, gold, and didn't know about it at 35 or 50, were in love with it at 200, right? In love with it. The price action justified the narrative. In 1975, Congress and the Fed raised the U.S. interest rate, and the gold price fell by half. It fell from $200 to $100 an ounce. Many of the people at $200 who were in love with it hated it at 100, when it was half as expensive. They wish they never learned to spell gold, only a 4-letter word, and got shaken out. And after they got shaken out, the gold price ran from 100 to 850. Past is in some measure prologue. The people who are most uniform in their love of a narrative, which is only recently proven, will be the first to be shaken out when the price action shakes their faith in the narrative. Mercifully, I'm an old man. I'm going to stay the trade to some degree until the reasons underlying the trade go away.